Hello and welcome to this special episode of the weekly briefing from Capital Economics. I'm David Wilder and I'm joined by Jennifer McKeown, Chief Global Economist, and by Hubert de Barochez, a Senior Economist on our markets team. They're part of a team that's produced our Spotlight project for 2024, which explores this issue of US economic and financial markets outperformance and whether this is a trend that's here to stay. The project launches on Monday, June the 10th with interactive data sets and an in-depth report, and there'll be in-person and virtual events across Europe, Asia, and the US to follow. Hi, Jenny. Hi, Hubert.
Hello.
Hello.
Jenny, Spotlight, this is our annual step back from the daily ebb and flow of macro to dive into what we think are going to be these tectonic economic and market issues to dominate in the coming years and decades. So last year was AI, looking at artificial intelligence and how that'll affect the global economy. The year before, we were looking at the breakdown in US-China relations. So let me start by asking why this topic, why US outperformance for Spotlight this year?
Yes, those previous Spotlight topics touch on this. The outcome of global economic fracturing is dependent on which economy is fundamentally stronger, and AI's transformational potential is dependent on which economy has technological leadership. And the US has certainly cropped up there. And coupled with that, the most frequently asked client questions of recent years concern issues like the risks around the US fiscal position, how sustainable US market valuations are, whether China's technological advances will allow it to overtake the US, and what it will take for Europe to harness its growth potential. So essentially, this project brings all those strands of inquiry together. And as we think about and try to articulate the shape of the global economy and markets between now and mid-century, which is something that many clients rely on us for, it really comes down to whether the US will continue to dominate the global economy.
When we look at the pandemic, post-pandemic era, it really has been dominated, hasn't it, by US economic and financial market performance. But to what extent is that just a continuation of a trend that we saw, I mean, particularly from the second half of the 20th century onwards? Is there anything special about recent years?
Yes, there are lots of special factors about recent years. Obviously, the pandemic was transformational, and what set the US apart in the couple of years after that was relatively strong fiscal support, which partly contributed to encouraging households to run down their savings to support spending. Some of that advantage actually seems to be fading now, and listeners will have noticed that the US economy seems to be cooling a bit. But the fundamental story has been one of outperformance of the US for a very long time. And in financial markets, you'll have noted that much more recently, with the optimism around AI really driving US stock markets higher. But looking back further, the US has been the world's largest economy since the late 1870s. It's grown faster than similar advanced economies. It's also been at the forefront of technology. And there are many examples of financial market dominance too, just beyond the stock markets, things like the dollar's dominance, for example. And we unpack all of that in detail in the report.
Yeah, I want to get onto the financial markets aspect with Hubert in a sec. But before we do, talking a lot about this idea of outperformance in the analysis, but give us a sense of how we're measuring that. What kind of data are we using to gauge this?
Well, the great thing about thinking about the US and other advanced economies is that there's really a wealth of data available over really long timeframes as well. The emerging markets can be more challenging, but we've managed to dig out a lot of data that can help us to compare and contrast. In the report, we compare GDP and GDP per capita right back to the 1800s. We look at how labour market flexibility compares to that elsewhere. Tax structures are very important. We've got lots of indicators of technological progress too, things like patent applications, venture capital. There's so much more in the report. And we've actually compiled a dashboard, a database for our advanced clients where they can go and download all of that data and create their own charts. So that's well worth looking at.
Yeah, so we're talking about much more here than just straight GDP growth measures, it sounds like. But let's drill down into some of those factors of outperformance, because I saw this story. They identified the reserve of lithium on the Nevada border last year of something like 40 million tons. That would make it, I think, the biggest on Earth. And it's a story that really underlies just how resource rich the US.
Yeah.
But, Australia and Russia, they've got lots of natural resources. And China and Indonesia have relatively large populations. And Israel seen as a sort of startup nation of entrepreneurs. So really, why the US? I mean, what are the ingredients for global economic development?
Yeah, well, you're right. Lots of economies have various strengths. But I think the thing about the US is that, well, for a start, it's so large. And that's a benefit just in terms of the number of people, but also economies of scale, and also the natural resources, which we've just talked about, which the US has done a good job of making the most of over recent years at developing. The report goes into a lot more detail about the specific facts that are driving US outperformance. But to take just a couple of factors, people in the US tend to work much longer hours, as we evidence in the report. Tax structures favour investment. Education levels are very high, and that supports innovation, as does the regulatory environments in the US. The US also has a cultural environment that encourages innovation and startups. It's interesting that in 2024, the US had almost 80,000 active startups compared to fewer than 10,000 in the UK, which was the next best among the advanced economies. So there are some real standout features about the US economy, which are all contained in the report and in the data dashboard. But I think what's most special about the US is the breadth of its success. It's succeeding across a variety of factors for various reasons.
But were we having this podcast in the 1870s, we might have been saying the same thing about the UK. History shows economies rise and fall, but sitting where we are, what does the US position look like further out? There's a temptation, isn't there, always to say what's happening now is going to continue. I know your analysis goes into some of the risks to that. So talk about some of those, would you?
Yeah, that's absolutely right. We may have said about the UK, but what we'd also have said is that it's clearly a much, much smaller economy than others. And I think it's always clear that those with much larger populations had the potential to overtake it at some point once their productivity picked up. Typically, it takes a combination of flaws in the leader's economic model and a challenger waiting in the wings with the right ingredients to take over for an economic leader to fall into second place or third. And we look at both of those possibilities in detail in the report. Some of the risks to the US in particular, the domestic risks relate to the imbalances, which have been much talked about, the US's twin deficits, its current account deficit and its fiscal deficit, and the vulnerability of the public finances. We look into that and what it might take for that to cause real problems for the US in the report. And what we also look at is the potential challenges that are waiting in the wings. And we focus on China and the EU. They also have very large populations, particularly in China's case. And China has been, of course, growing very quickly. But what we identify are several major flaws in their models. In China's case, the state-led model, which has led to some inefficiencies. For the EU, it's more about the inflexibility of labour markets, which have meant that unemployment rates are much higher. Now, there are various things that could change that, but our take on this is that's fairly unlikely to happen to the extent that either of those could really challenge the US. But I'd very much encourage looking at the report to think about those risks in a lot more detail, because we do assess them in some depth. We look at India too, another economy with a really large population, and we're quite optimistic there. We think it will grow quickly, but even by 2040, it will still be only around a third of the size of the US, even based on our relatively optimistic forecasts, and also much poorer in terms of its GDP per capita.
Hubert, let's bring you in at this point, because the question about the ongoing dominance of US financial markets is key to all of this. This isn't just about macro leadership. US equities have been notable outperformers for some time now. Given what the report outlines in terms of the drivers of US economic strength, I mean, is it the case that strong economy equals stronger earnings equals higher stock prices? Is it as simple as all that?
Well, it hasn't always been the case that US dominance or US economic dominance has translated into US equities outperforming. It was not the case, for instance, throughout the 50s, 60s, and 70s. However, this has certainly happened since the global financial crisis. And in fact, since then, equities in the US have returned 5 times more than equities in the rest of the world. And surely, stronger economic growth has helped. After all, stronger economic growth means output from the economy and in terms of the corporate sector growing more rapidly. And this certainly makes it easier for companies to make profits and therefore for their earnings to grow. So it's been a great help for the US stock market that economic growth in the US has been stronger than in the rest of the world, at least in the rest of the developed world since the global financial crisis. However, there have been other factors beyond the outperformance in US equities. So we go through them in detail in the full report, but I think the big picture is that the US stock market has primarily benefited from both the strong profitability of listed companies in the US and from valuations in the US rising much more rapidly than elsewhere. And that's notably the case in the tech sector, actually.
Yeah, you mentioned the tech sector. I wanted to ask, what's been driving the outperformance? As we're recording this on Friday morning, we've seen another extraordinary week for NVIDIA shares. How much has what we've seen been about big tech outperformance, and looking ahead, how much can we expect big tech to drive this?
So, yeah, big tech has definitely been an important factor behind the outperformance of US equities. This has been the case since the global financial crisis. The IT sector in the US has largely outperformed the rest of the US stock market and largely outperformed equities in the rest of the world. And in particular, since the pandemic, really the US stock market has fared particularly well due to the listing of big tech firms, most of those being the Magnificent Seven and NVIDIA in particular, which you mentioned. And these are really been an important factor driving the outperformance of US equities since then. And most recently, so since, say, late 2022, early 2023, this has reflected growing enthusiasm about AI. And we actually think that such enthusiasm will continue to grow in the next couple of years and will actually fuel a stock market bubble in the US stock market. That said, I should temper the story a bit. As we discussed in the full report, big tech performance has not been the only factor. It's not been the whole story behind US stock market outperformance. And that's simply reflecting the fact, for instance, that non-IT US equities have also largely outperformed equities in the rest of the world since the global financial crisis. So big tech has been an important part, but it's not the only reason why the US stock market has done so well since 2010, really.
You just mentioned the B word, the bubble. We've had this high-profile call for a bubble in US equities to inflate through to the end of next year. Talk about the end of that bubble. Does that mark the end of US equities outperformance? And would the bursting of that bubble have some knock-on effect on the economy and this question of US macro outperformance?
Yeah, sure. So, well, the report maps out in full detail what we think will happen to US equities and to US outperformance over the short term, the medium, and the long term. But what I can say in a few words is that we do think that the bubble that is currently inflating will eventually burst, and that this will indeed mark the end of US stock market outperformance. And one reason is that as the bubble bursts, we suspect that equities will fall the most sharply, and that's simply the logical implication of the fact that we expect them to lead the charge when the bubble inflates, and notably because of the dominance of big tech firms there. And further ahead, when the dust eventually settles, we think that most of the drivers of US equity outperformance will have faded, and therefore that equities in the US will deliver similar returns to those in the rest of the world in the long term. So obviously, if a stock market bubble inflates and bursts in the US, there's a question of whether that could endanger US economic dominance. And actually, we think that this will not be the case. Similarly, the same way that the bursting of the dot-com bubble in the early 2000s didn't endanger US economic dominance, we don't think that this time around it will be very much different. So we think that the US will continue to dominate the world economy.
Hubert de Barochez and Jenny McKeown talking about US macro and market outperformance into the 21st century. As I said, Spotlight 2024 launches Monday, 10th of June, so the day this podcast is going out. It's going out at 10 a.m. New York, 3 o'clock London, and launching with an in-depth report and interactive data dashboard. But that launch also marks the starting point for a stream of analysis on this specific issue. It's not just a standalone one-off report, and all of the data and all of the analysis will be housed on our Spotlight 2024 page. That's capitaleconomics.com/Spotlight 2024. I'll link that in the show notes of this podcast. You'll doubtless have lots of questions about the report's findings. There's loads in there, and there's a series of events in the works for you to grill the team and further the discussion. It starts with a London get-together on June the 11th. Details about that are on the Spotlight page. But if you can't make that session, then look out for drop-ins. Those are our short-form online briefings that are happening in Asia and US times on Thursday the 13th. Again, look for that on the page, and the team will be in North America and in Asia in person in the coming weeks and months to meet up and talk more about the analysis. Get you details of all of that as it comes together. Our regular weekly podcast will be back next week with Neil Shearing once again in the chair. There's going to be lots for us to go over, including the latest US inflation numbers, the Fed's June meeting, as well as a preview of the Bank of England's June decision happening on the 20th of June. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.